Good evening. What we are witnessing is a seismic shift in the foundations of global finance, emanating from a source long considered a bastion of calm. A decisive move by Japan, a nation synonymous with decades of predictable, ultra-loose monetary policy, is now sending powerful tremors through bond markets worldwide. This is not a minor adjustment. It is a fundamental change of course that has caught traders, governments, and major institutions off guard, forcing a frantic global reassessment of what comes next. In recent days, Japan's government bond market has performed what many analysts deemed nearly impossible under the prevailing conditions. Yields have surged, pressure has mounted, the currency market has reacted with considerable force. Crucially, this is far from a localized event. The movement in Japanese government bonds has triggered a chain reaction across the global debt landscape, from Asia to Europe and directly to the United States. We are seeing investors globally suddenly question the safety of their assets, the stability of their long-held strategies, and the very future of international capital flows. Tonight, I will lay out for you precisely what Tokyo has done, why this policy shift has so profoundly shocked financial experts, and how it is now actively pulling capital out of foreign markets. You will come to understand why a stronger gravitational pull from Japanese bonds directly weakens demand for United States Treasuries. We will examine how acute currency pressures are unraveling long-established strategies, most notably the yen carry trade, an engine that has fueled global liquidity for a generation. And we will reveal how these under-the-radar forces are quietly cornering US assets. The public discourse focuses on interest rates and inflation figures, but it largely misses the critical machinations that occur when a major financial power pivots. The quiet unwinding of leverage across Asian financial centres, the preparatory moves by major banks for sudden liquidity shifts, the recalculations by pension and sovereign wealth funds when a new opportunity arises at home. These are the less visible details that transform this event from a mere headline into a moment of genuine global risk. By the end of this report, you will understand the deeper narrative behind Japan's decision. You will see how a single policy adjustment can send ripples through bond yields, currency flows, and overall market confidence. You will hear why leading analysts are now warning of a potential reversal in trends that have shaped international finance for over 30 years. And you will gain a clear perspective on what this evolving situation means for the economic environment here. For decades, Japan's reputation was built on a singular, simple principle: keep money cheap. The Bank of Japan maintained interest rates at or near zero, even venturing into negative territory, creating one of the most permissive monetary environments on earth. Banks borrowed at virtually no cost. Companies raised funds without pressure. Investors operated with absolute certainty that the central bank would flood the system with liquidity. This was never merely a domestic strategy. It became a formidable global force. With borrowing costs in Japan so remarkably low, international investors adopted the yen as the world's premier funding currency. They took out low-cost loans in yen and deployed that capital into higher-yielding markets abroad, into US bonds, global equities, real estate, and emerging market assets. This practice evolved into a colossal financial mechanism, the yen carry trade. It incentivized global risk-taking, propelled capital to distant markets, and propped up asset prices worldwide. However, the tone emanating from Tokyo has distinctly changed. That era of endless cheap money is now showing profound signs of strain. We are now seeing the direct consequences of a major policy recalibration in Tokyo. A shift driven by the inescapable pressures of rising inflation, a depreciating currency, and growing concerns over financial stability. The long era of limitless cheap money is under profound strain, and the markets are receiving the message loud and clear. A fundamental change is now underway. In recent weeks, we have witnessed a sharp and significant climb in the yield on Japanese government bonds. Both short and long-term debt are now trading at levels not seen for years. This is not a minor fluctuation. It is a decisive signal of changing expectations. The investment community now operates on the belief that the Bank of Japan is preparing to step away from its decades-long commitment to near-zero interest rates. In monetary policy, even a hinted adjustment from a central bank of this stature sends powerful ripples, and this time the reaction has been immediate and forceful. This higher yield presents a new reality. Capital kept within Japan may now offer a substantially better return. Simultaneously, the yen has continued its decline. A persistently weaker currency forces foreign investors to reassess the long-term value of any yen-denominated asset. For the vast network of investors who borrowed in yen to fund ventures abroad, the famed carry trade, this currency shift fundamentally alters the risk calculus. Profits from those long-standing strategies are being eroded, transforming a once reliable engine of global finance into a source of instability. Now consider the combined effect of these two forces, rising domestic yields and a falling currency. The result is a powerful gravitational pull back towards Japan's own bond market. Japanese debt begins to appear increasingly attractive, especially when compared to foreign assets whose relative advantage is swiftly diminishing. Capital that for years flowed outward in search of yield is now under intense pressure to repatriate. Domestic and international investors alike are being compelled to answer one critical question: where does capital now find its safest and most reliable return? Given Japan's position as one of the world's largest creditors, this recalibration does not remain within its borders. When Japanese bond behaviour changes, the movement of capital across continents shifts with it. The nation's pension funds, insurance giants, and major asset managers hold truly enormous quantities of foreign debt. Even a modest strategic adjustment on their part can reshape global demand. This is not a theoretical concern. It is a recurring pattern witnessed whenever Japanese policy stirs. As yields become more appealing at home, these institutional investors inevitably reappraise the value of holding riskier foreign bonds. The choices are straightforward. Some will actively bring capital back to Japan, while others will simply cease new purchases abroad, withdrawing the steady, reliable support that many markets have come to depend upon. The consequence is a weakening of global bond demand. Basic economics then takes over. Lower demand pushes prices down, and falling prices force yields up. This dynamic can accelerate rapidly, particularly in markets already contending with inflationary pressures or heavy government borrowing. The ramifications extend globally. A broader bond sell-off exerts direct pressure on core benchmarks, most notably United States Treasuries. If demand for American debt cools precisely as Japanese yields rise, the US will likely see its own borrowing costs climb. This makes credit more expensive for everyone, from the government to corporations, forcing a wholesale reassessment of valuations and risk appetite. Assets built on the premise of stable low yields, a cornerstone of the modern financial landscape, will feel the strain immediately and acutely. It is critical to understand that when the bond market tightens in this manner, the pressure does not remain confined to debt. It spreads decisively into risk assets across the board. Equities, high-yield bonds, and even digital currencies. All of them depend on two things: abundant global liquidity and a robust appetite for risk. Should that capital become more cautious, the foundation of support for these markets begins to erode. The result is a pullback by investors, a sharp increase in volatility, and a far more fragile financial environment overall. For years, the mechanism known as the yen carry trade operated as a quiet but powerful engine for global markets. The strategy was straightforward: borrow yen at rock-bottom rates, convert it into other currencies, and channel that capital into higher-yielding assets abroad. As long as Japanese interest rates remained anchored near zero and the yen was stable, it was a reliable source of profit with perceived limited risk. This system was not some niche trade. It was utilized by funds, hedge managers, and major institutions to amplify returns and sustain positions in markets thousands of miles from Tokyo. That entire structure is now coming apart. The dual forces of rising Japanese yields and a persistently weaker yen have shattered the fundamental arithmetic of the carry trade. The cost of borrowing is no longer predictable, and the currency movement injects profound uncertainty. Consequently, investors who once confidently employed this strategy are now unwinding their positions. Some are closing trades outright, others are hedging aggressively, systematically reducing their exposure to foreign markets. This unwinding is not a trivial shift. It represents a significant reflux of capital back toward Japan. But the impact is greater than a simple geographic transfer of wealth. It actively drains the pool of fast-moving speculative capital that circulates through global markets. The sums repatriated are substantial, and the investors who remain internationally become inherently more cautious, curtailing new positions and suppressing their appetite for risk. The effect is a broad-based liquidity drain from the world's financial system. Assets that prospered on a steady diet of foreign investment now face a withdrawal of support. With liquidity thinning, pressure mounts acutely on US assets, emerging markets, and other risk-sensitive areas. The number of investors willing to take bold positions or chase high yields dwindles. Momentum-driven markets can slow abruptly. Asset prices, inflated by years of easy money, now face the strain of evaporating demand. Even typically resilient sectors are not immune to volatility when this global tide of speculative capital recedes. The current shift in Japan's financial landscape presents a clear mixture of risks and opportunities that global investors can no longer afford to ignore. As yields climb and capital flows reverse, bond markets worldwide face a period of heightened volatility. Rapidly rising yields mean falling prices, a dynamic that can unravel portfolios constructed for stability. Even United States Treasuries, long considered the ultimate safe haven, may face pressure as demand softens and investors insist on higher returns. Equities will feel the impact, particularly in sectors sensitive to borrowing costs or foreign investment. Crucially, any investment that relied heavily on the carry trade dynamic is now exposed. Many emerging market bonds, for instance, have depended for years on cheap yen financing and the steady inflows it enabled. As that support vanishes, these markets risk sudden liquidity crunches, sharper price swings, and climbing yields as risk is repriced. Even segments of the cryptocurrency market, which tend to thrive amidst abundant liquidity, may experience significant stress as global financial conditions tighten. This is the inevitable reckoning. High-risk assets invariably struggle when the world's investors move into a defensive posture. While these global tremors present clear risks, it is important to recognise that the shifting environment within Japan also creates distinct opportunities for its domestic investors. Higher yields on yen-denominated assets now offer a more compelling reason to keep capital at home. We are likely to see increased attention directed towards Japanese government bonds, corporate debt, and even select sectors of the Tokyo stock market as their relative returns become more competitive. For many Japanese institutions, this new calculus provides a long-awaited chance to rebalance portfolios, reducing a heavy historical reliance on foreign exposure and bringing investment focus closer to home. These domestic developments, however, serve as a critical early signal for international markets. Any investor holding bonds, high-yield products, or assets sensitive to currency fluctuations should now prepare for a period of heightened turbulence. To dismiss this as a distant regional shift would be a profound misjudgment. In our interconnected financial system, the effects of Japan's strategic pivot can transmit with startling speed. The signals from Tokyo are now unequivocal. Rising domestic yields coupled with a weakening yen are actively reshaping global capital flows. The consequences are already being felt in bond markets worldwide. As Japanese capital is pulled back from foreign investments, the resulting pressure spreads rapidly, placing immediate strain on core assets, from United States Treasuries and European sovereign debt to a broad spectrum of risk-sensitive investments. What initially appeared as a localized policy adjustment has evolved into a formidable force that financial systems across the globe must now confront. In the coming weeks, several key indicators will determine the scale and duration of these ripple effects. The next policy decisions from the Bank of Japan will be paramount. Any suggestion of further monetary tightening could sharply accelerate the capital repatriation already in motion. The response of global bond yields, particularly those on US Treasuries, will reveal the true magnitude of the reaction to diminishing Japanese demand. Simultaneously, the trajectory of the yen against the dollar will provide vital clues into ongoing capital flows and currency risk. Finally, observing how major institutional investors reposition their global portfolios will indicate whether this is a transient shock or the inception of a deeper structural trend. This situation underscores a fundamental truth of modern finance. In a globally connected ecosystem, a single policy adjustment in one major economy can send decisive waves through the entire system. That wave has now originated in Japan, and its full impact is still unfolding. The next phase will be dictated by the collective response of investors, central banks, and financial markets to this altered environment. It is a developing story that demands close and sober attention.